later. But broadly, savings went up. It started coming down, and Biden got elected, and they turbocharged it because the Dems, the progressives said, this is our turn. And so let's do that other $1.8 trillion stimulus that we didn't need. And this is for PPP. Like at school, COVID was almost over, and we're now giving like billions of dollars to schools for PPP that no one wants. But all this money pumped in the economy. So personal incomes went way back up, savings rate went way back up. That's been falling. Savings rate's now negative, but the pile of money isn't gone yet. So while the savings rate is negative, the net savings is still positive. And so you're seeing credit card debt starting to pick up again. So we're going to eat through that, but we haven't eaten through it yet. So until then, let's go to the Caymans, right? Let's go out to Novo and or buy something at Louis Vuitton.
Well, do you think we go into recession, or do you think we avoid? How are you thinking of?
I think we go into recession because that savings will evaporate. Negative savings rate by definition. You're seeing layoffs in lots of big companies. We had wage surge; it's coming off pretty quick, right? And so, my guess is we at least have a mild recession, and that that the Fed raises 25 next month or in 2 weeks. And then that next meeting probably raises, but probably shouldn't.
Yeah,
right.
I agree.
But there'll be a debate, right? Why macro is tough is, let's assume that's the truth in the U.S. If you start seeing China come back and Europe doing better and global commodity prices, we can get inflation down to 3.5%, 4%, from whatever 6. But can you get it to that next level down to 2? And does then after that pause, we're always used to pause cut, right? The market's pricing in pause cut. And that's probably what happens. But there's another side of your brain that's saying you could have a reacceleration, right? So that story, and I think that's why, again, my buddy said, I just might not invest this year. It's that complicated of a...
It is complicated, right? I'm like you, I'm kind of more of a deflationist, and I think over time it probably comes lower. But there's this other distinct probability that things come back too fast and we create inflation again. So I'm not sure how much rates come down. Sure, the 10-year can come down a bit in the meantime as growth comes down, but do rates come down a lot, or do they cut them down to 3 and then they get stuck? I don't know. How do you think balance of probabilities rates are next year?
Yeah, I think if they cut, they're not going to cut 25, right? They'll cut 50-50 and then see what happens. And so, the market's not that unfairly priced. If you think 25-25, wait 5 months and cut 50-50, that would be the normal pattern. But there's a shot at 25-25 and they wait and they're like, well, until we really see inflation going below 3.5, let's just sit here.
But if they do that, so I've been talking about this with people because there's a lot of people think there's a second surge of inflation, and the Fed kind of think that. So we're going to stay. So therefore they're guaranteeing there's not going to be the second wave of inflation, and therefore 10-year yields collapse, which is very positive for the risk asset space that we all love.
Yeah, so that's, listen, there's this balance between, so Powell embarrassed himself by being so late to hike. And there was some strategy there. He wanted to get reelected, period. He wanted to get reelected because he thought he was the right man for the job. He didn't want Leo Brainerd in the job. He thought he was the guy to take the Fed through this hard times. And if that's a good strategy or not, that was a strategy. And so he definitely doesn't want to be seen as Arthur Burns, right? And so I think they're going to they're going to talk hawkish, and they're going to be hawkish. And they've been kind of bailed out by this tight labor market, now they're going to get the global growth. And so, they're softish landing it. In some ways they're doing a really good job. Stock market's at an okay price. Just intuitively, what makes me nervous, it's hard to think you had the greatest asset bubble in the history of the world, and then fueled, with the cherry on top by COVID, and 11 months of a bear market's all you get. Right? We're still above pre-COVID levels in everything. People often miss is Bitcoin's way above. Like everyone says, oh, crypto stocks. I'm like, what are you guys talking about? Bitcoin has way outperformed all growth stocks during the, pre-COVID to now.
Oh yeah, by a long way, massively.
Listen, our industry needs a colonic.
So I want to come into the industry for a second, but just the last question about this macro stuff. Does level of rates matter, or rate of change? Because I'm not sure anybody gives a shit if rates stabilize at 4%, because you kind of build in a hurdle rate, you know what your funding costs are. You figure it out, you lay off some
No,
staff,
I
you
think
move on.
people aren't through that transition yet. Like your LIBOR plus 100 loan that you were making investments with, 1% is very different than 5% or 6%. And so I do think levels matter some. They don't matter as much as rate of change, but I do think they matter some. Literally since 2007, not a serious adult non-professional, but like mom or dad, should have bought one scintilla of fixed income. Not one, right? You don't call your grandmother and say, hey, grandma, put your money in 30 years at 2%, right? And so this is the first time people are buying, say, hey, I can actually buy New York munis at 6% or treasury bills at 4.5%. And so fixed income is becoming a real asset allocation to just normal, wealthy, not so wealthy, savers. And that's a shift, right? And so I don't think, unfortunately, growth comes back screaming, right?
No.
Like that was fueled by cheap money. That I think is just going to be a reality for a while. What would change that? Not a lot. You would have to literally see kind of a global catastrophe and, the deflation tornado come back. But that's just so hard to see given the structural shifts that have happened.
Yeah, and I think a lot of people aren't talking about what does GDP look like on the other side of this recession. I think it's probably slow. Because if you say if the Fed keep relatively tight, the economy's slow, and that's a different world to deal with. It's not as easy. So talking about what happened last year, I want to get to the structure of the markets now in crypto. It really reminded me of long-term capital, where we found that was one player, basically that, Barry's trust spreads blew out, which was like the swap spreads when long-term capital blew out. Three Arrows Capital were the long-term capital. They were everybody's biggest clients. And then lo and behold, everybody went bust. It's like, I've seen this playbook before. Interesting enough, the hedge fund industry, after LTCM, as you know, everyone's like, it's uninvestable. They're over-levered, it's opaque. What happened is the assets under management went up 5x because of regulation and everyone tightened up risk. But it felt like we've seen this playbook before, you and I, many times over. It's not unique to crypto, right?
Yeah, which was unfortunate. Crypto had this story of transparency. I must use the word 10,000 times in the last 5 years when I was talking about crypto. Transparency, egalitarian, fairness. And we had really big, giant, opaque players. But you think about Celsius, crazy leverage. BlockFi, crazy leverage, right? Genesis, crazy leverage, crazy concentration risk. Three Arrows, bizarre. Credit groups like ours make decisions to lend people money based on balance sheets. And you don't go off like kamikaze saying, I'll just lend them money. And so I am hoping that most of that gets, I know most of it's been washed out of the market, that it gets resolved sometime over the next 18 months. That weighs heavy on liquid assets, right? Because all these places have liquid assets. They sell the liquid stuff. And so that stuff just gets disposed or held or pushed around. And so they played an important role in driving asset prices up, right? Like, how do you get leverage into the system? We were getting it through the Asian exchanges, and we were getting it through these big brokerages that were then lending it on. And so we have a pretty deleveraged system right now.
But it's got to be difficult to run books, right? I'm thinking of hedge funds as well, market neutral guys, anybody doing anything, can't get any fucking borrow. There's one big firm, which is Binance, and nobody wants to take the credit risk. It's difficult.
What was that line of The Godfather? Difficult, yes. Impossible, no. It is more difficult. It is not impossible. And we're starting to see a thaw. An instinct I have is that crypto has been a retail-driven phenomena. I was called the people's revolution, right? I think retail will take us out of this bear market. Not with no help from institutions, but it's going to take retail. Like the cheap money that will be lent will be retail money. And what's interesting is people believe in this space. They make mistakes, they see frauds, but they come back to it. They believe in decentralized systems. They believe in Bitcoin. They believe in Ethereum. They believe that in time we're going to cut the middleman out. Do they feel silly that we talked about decentralization and, we had this one giant player in FTX that literally lied through their teeth and was really one of the core pieces of infrastructure? Yes. Everyone's like, duh. But they haven't given up on the dream. And how I keep 400 employees working here is